Good afternoon, and thank you so much, everyone, for joining us. In just a few minutes, I'm going to bring Anthony Ornella on, and he's going to give us information on investing in startups after COVID-19. I know we're all dealing with this. It's such an interesting time to be alive because there's so many strange things going on in this world based on the pandemic and everything that we're seeing. So we're going to talk about that in just a few minutes. Before we do that, though, I want to talk a little bit about Advanta IRA. So my name is Larissa Green. I am with Advanta, and I've been with Advanta since 2011. And I'm going to kind of walk you through Advanta IRA's portion of this webinar and give you some information on how we can partner with you if you decide to make those business investments and you want to use IRA funds. So that's sort of where we come into this. And so um, again, before we invite Anthony on here, I'm going to just kind of go over what we can do to help you when you're looking at those types of investments and you want to use retirement funds to do so. So Advanta does not actually offer any investment, tax, or legal advice. What we do here instead is give you the opportunity to learn with us about the different rules and strategies for self-directing an IRA. So there are rules involved you want to be aware of when you're making investments through a self-directed retirement account, and different strategies can be used in order to abide by those rules. And so we're going to go through just a tiny little bit of that today, but if you're interested in learning more about those rules and strategies, we have webinars all the time, and I'll talk about that in just a second. I do want to make mention that if you have a question you're not sure if I can answer, you are certainly welcome to ask it anyway. And if it does fall into that legal, tax, or investment advice category, then what I can do is refer you to a professional that has worked with our clients in the past, and they can certainly help you figure out any questions that you might have. A little bit about Advanta. We are a self-directed retirement account. We only and third-party administrator. We only handle qualified funds, so that means we can't help you with any personal cash. We actually don't sell any investments at all. We just act as a third party. So we hold the account per IRS rules, and we help you make the investment. And the important part about us not selling any investments is that really gives you the opportunity, if you will, to find those investments that you feel are going to be best for you and best for your retirement account, bring them to Advanta, and then we're going to help you get them done in the name of the retirement account. And the purpose, of course, of that is so that your retirement account remains tax deferred or tax free, so under that retirement umbrella. We've been doing this for nearly 20 years. We have over $1 billion assets under management, 7,000 plus clients nationwide and even worldwide. So basically, you just have to have a US based retirement account in order to self-direct it. And I have clients, for example, that make investments into private equities that are overseas, or they buy land in places like Costa Rica. And so all of those things are allowed, just as long as your investment is within the rules. We have two offices. We're in the Tampa Bay area of Florida, and then we're also in Atlanta, Georgia. But our Tampa Bay office is actually the one that handles all the back office work. So we're here in Tampa Bay, depositing checks, opening accounts, handling clients' transfers, helping clients make investments. And then our Atlanta office is actually more of like a sales and education office. All of our clients receive personal account service, so that means that they have an account manager that is ready to assist them in making investments, handling contributions, and everything from there and in between. So that's a little bit about Advanta. A lot of times people join us for these webinars and they may have done, a Google search, businesses and COVID, and they find the webinar and join us. And so I just want to give you a little bit of information about what a self-directed IRA is. And so if you're not familiar, just very broadly, the definition is that, these types of accounts allow you to make the investments you choose. But more specifically, a self-directed IRA holds assets outside of the market. So I mentioned we don't sell anything at all. We're not a broker dealer, and we don't handle investments with brokerage types of accounts. So no stocks, bonds, and mutual funds that are publicly traded. Everything we hold is outside of the market. It's considered a private investment. And so what that means is we're not really competing with brokerage firms. What we do instead is fill the gap in the industry where your brokerage account isn't willing to hold something like private business stock or a mortgage or note, pieces of real estate. It's just something that they're not as familiar with. They don't want to be involved or have fiduciary responsibility. And so what we do is come in and say, okay, you don't have to move your entire account. It's not an all or nothing strategy, but instead you can move over just the portion that you want to self-direct. So that's, for our purposes, our definition of a self-directed retirement account. I also want to mention before I forget that if you have any questions, go ahead and make sure that you type your questions into the chat box. And then from there, we'll get the questions answered as they pop up. I did have a question about continuing education for CPAs. I'd be happy to provide you with the information you need in order to report it, but whether or not it would qualify, you would just have to check with your agency on that. So if you are looking for continuing ed credit, please email me. My contact information will be on again at the end of the webinar, and I'd be happy to provide you with a certificate. Whether or not it qualifies, again, you'll just have to check in with the reporting agency on that. So let's go on here. I kind of mentioned this already, but the reason people really haven't heard of self-directed retirement accounts is because brokerage firms are really unwilling to hold private investments. They typically will have a self-directed type of account where they give you a list of investments and you can choose from those investments and trade and purchase and sell at will. But our definition is a little bit different, and so there's just not a lot of administrators like Advanta out there. Many people haven't heard of this, and oftentimes when I meet people, they say, well, this must be a brand new concept. And as a matter of fact, you've been allowed to make these types of investments through a retirement account since 1974 when IRAs were created. So really the bigger problem is, there's very few of us, and we're doing the best that we can to get the word out there that you don't have to 100% be invested in the stock market. But just based on the number of retirement accounts, it's nearly impossible to speak to every single person, of course. So a lot of times people are self-directing for lots of different reasons, but to give you an idea of what we sort of see, reasons people want to self-direct, the very first one is going to be a new source of capital. They had no idea that they could make these investments and they could turn to their retirement account to pull from in order to make investments. So when I talk about the example, investing in businesses and startups, you'll see, somebody might come to you and say, hey, I have this great business concept. I'm thinking about offering shares to investors who want to work with me on this. And hey, did you know you could use a retirement account? Many people don't know that. And of course, oftentimes your IRAs or 401ks are going to be much more liquid or have the ability to be liquidated easily versus personal cash and personal investments. And so when you turn and look at where you might pull that money from, retirement accounts oftentimes make sense for this. Stock market fatigue, and I know a lot of people are experiencing this right now during COVID because the stock market is all over the place. I mean, if you're watching it, you probably have a headache because where is it going to go from here? It's been up and down so much in the last 6 months. It's, an interesting roller coaster for sure. And so people just get tired of worrying about it and say, okay, if I invest in something like, private stock, private equities, or real estate, I'm going to know sort of have a better direction as to where my money is going to end up. And then, of course, the tax benefits. The investment remains tax deferred or tax free depending on the type of account. And so those are the three main reasons we will see people self-direct retirement accounts. I just want to mention really quickly the types of accounts that can be self-directed. I think oftentimes people think that it has to be a Roth IRA. I'm not really sure where that comes into play, but many people will tell me, well, I don't want to do a conversion and pay the taxes and have a Roth IRA because I have a traditional 401k, and so I'm just not interested in paying the taxes at this time. Well, as a matter of fact, if it ends an IRA, it can be self-directed. Any type of former employer plan. And former employer plan is emphasized because if you're currently employed, many times your employer isn't going to allow you to take money out of that plan and move it to an IRA in order to self-direct. But there are exceptions to every rule, of course, and so I would just suggest checking with your employer if that's something you're interested in doing. And then I also have up here health savings accounts and education savings accounts. And the reason they're listed is actually the rules for self-directing them are exactly the same. as IRA accounts, and so we can help you with those as well. And while I'm on this slide, I just want to mention we also have the opportunity for you for solo 401ks, and so those one participant plans where you, if you're self-employed, if you're an independent business owner, or a sole proprietor, you can also contribute to a 401k, and it's actually a great plan, and we can help you with those as well. And I also want to mention that we have some deadlines coming up. So, of course, contribution deadlines were extended with tax filing. So if you have questions on those, please feel free to email or give me a call, and I'd be happy to discuss those deadlines with you. So I mentioned there's some rules for self-directed accounts, and I just want to touch on them very quickly before I give you an example of how investing into a business or startup works with an IRA. So the IRS requires that all the investments you make are considered arm's length transactions. And what that means to you is that when you make investments, you cannot transact, meaning buy, sell, exchange, provide goods or services to, or with certain disqualified persons and entities. And so here on my chart, you're going to see the IRA holder is considered disqualified, IRA holder spouse, children and grandchildren, parents and grandparents, and any business entities or spouses of those. And that's very important because especially when you're talking about investing in startups, you want to make sure that your investment is considered arm's length. So if you have, an old college roommate or a friend that's looking for raising capital, looking for money for a startup, that might be okay. But, for example, investing into my son's business or my daughter's business, that is going to be considered prohibited. So you want to look at those types of things. And if you have questions on that, you can let me know. But that just kind of gives you the overall view of how disqualified persons and prohibited transactions work. And again, we do webinars all the time based around the rules. So if you want to learn more, you can either check our YouTube channel or follow our calendar, and we'll have things posted that will cover that information. So I'm just going to go over a case study really quickly for you, and it's on private investments. And I apologize, I left the case study number up here wrong. But obviously one case study on making private investments. And so this idea, again, just to give you a general idea of how a self-directed IRA makes these investments. So Jane has $100,000 in an IRA with Vanguard. It could be with anybody in any amount, but just the idea being that she has a friend from college, Randy, who is starting a business for a new app and has an offering for investors. So he approaches Jane and lets her know, hey, I want to start, I want to have people help me make this investment, start a business, make my app, and put it out there to the public. I'm raising capital in order to do so. And Jane decides that she wants to use IRA funds to invest. And so she's going to open an IRA account. We do hold the IRA account for you. That's important. You do have to transfer funds over to Advanta prior to making the investment. And that's important for IRS purposes because that's just going to really show the flow of funds, almost really like show on paper that when we received the retirement funds to an IRA with us, and then from there the investment was made. So again, just important part of the process. She's going to complete a transfer form with us that we will send to Vanguard requesting that they send the funds over to Advanta. And then we will let Jane know once we receive those funds. From there, Jane is going to let her account manager with Advanta know that she's investing in Randy's new startup company. And so Jane or Randy will provide us with the subscription document that shows Jane's IRA as a subscriber into this investment, and that's again very important. So instead of Jane's personal information in her name, Jane Smith, the investment is being made in the name of her IRA. Once you open an account with us, we do give your IRA a title, and so that vesting is for Jane's purposes, Advanta IRA for benefit of Jane Smith, IRA number 1234. The tax ID is Advanta's trust tax ID and not her social security number. She doesn't want any of the income being reported to her social security number. It has to go to the IRA's ID because that's going to show, again, tax deferred information for IRS purposes. So once we have Jane's approval, she's agreeing to invest X amount of dollars with Randy's investment. She's going to read and approve all of those documents. And once that is done, we will sign on behalf of her IRA and fund the investment. Any future dividends or profit are divided among the investors and deposited to Jane's IRA account. And Jane's account gains are not included in her income. Again, it's to the IRA. I think it's very normal for us to consider publicly traded stock in an IRA account, and we don't even think when there's earnings or losses in our retirement account with something publicly traded, because that's the most common type of investment that people see. But when you think about something like private stock or private investments, private equity, a lot of times people say, well, what if there's a gain or a loss? Well, it's treated exactly the same. It doesn't matter if it's publicly traded or not. The gains and losses are to the IRA and not to Jane herself. And so that's very important. And once the investment is paid off, it goes back to her IRA. And again, no tax consequences to Jane personally. So that just kind of gives you an overall look at how that investment is made. And so with that, and if I don't see any questions in the chat box at this time, and again, I would encourage you to put any questions you might have in there so that Anthony can help you with your questions. So I'm going to invite Anthony on now. How are you doing today, Anthony?
Oh, living that quarantine dream, Larissa, just having a great day.
Absolutely, absolutely.
Well, thanks for having me on again. It's always a pleasure to be here with Advanta IRA, and to all of those listening on the webinar. Thank you for your time. That is your most valuable resource, and we appreciate you sharing it with us. And for all of those recording and listening to the recordings, good on you. I'm proud of you for going back and listening to it. So, as Larissa said, my name is Anthony Ornella. I work as a personal CFO and financial consultant for Jared Bunch Consulting. And we're going to talk a little bit about COVID-19 startup and business investing and kind of what has changed and what has looked for. So let's jump into the mix here. Larissa, I'm having a hard time finding the arrow on.
Do you see it now, Anthony?
I do. Awesome. Great. So what we're going to go over, what things have changed. Obviously, the world is a bit different right now. What opportunities did that change bring about? Where should you be looking? That's a really hot topic. If you've never done this business or startup, where should you look for some of these opportunities? I think it's equally as an important point to look at what has not changed, what has kind of remained steady Eddie through not just this recession, but the others in the past. And then kind of closing it out with what should you truly be looking for when it comes to these kind of startup opportunities and these business opportunities. So let's start here. What hasn't changed, or what has changed? One of the biggest would be how things are delivered, whether it's a physical product, whether it is a physical or non-tangible service. How those things are being delivered is very different now across the board. Maybe people were dipping their toes into one way of doing things, but this pandemic has really forced people's hands. So with social distancing, telework wasn't just the sole focus, but client interactions. Now, what you want to be looking for when you're kind of evaluating opportunities or evaluating businesses is, were they looking to eliminate that human component of service beforehand, and this forced them into pivoting more quickly? Or are they doing a temporary shift to telework, a temporary shift to socially distancing their services, and are looking to get back into how they always did things prior to? So from easy delivery of goods and easy contactless pickup of goods, to even solar installation companies using drones to do the actual roof surveys. So there never has to be an actual person in or around someone's house. And so kind of where you want to look as far as how things have changed is this a temporary shift? Or is this a permanent shift that just was brought about more quickly for that business? Not saying it's good or bad. It's just that habits are formed about 26 days at a time. So if you are looking to invest in a company who has made a temporary shift, know that there could be some rocky road ahead for them as they get back into their old habits versus some of the new things that they have put into play. The old "I'm going into the office" nowadays is much different than it was a few months ago. The definition of an office has certainly changed. there is some opportunity in there. So overhead is lowering for the most part. If you have a SaaS company, software as a service company, technology, if your workforce is primarily inbound and outbound calling centers, the office space is much different. Commercial property, especially large commercial property, seems to be on sale right now. People are leaving the office space and moving to a telework because they're seeing how productivity has either remained the same or improved without the need to have everybody coming into the office. And people are finding more time to do their necessary work without their regular interruptions. So the commute to and from, regular chats with office mates, despite their new office mates being maybe young children or their spouse, they're having to adjust to. With that, again, not saying this is right or wrong, but it is something to consider. As things have changed right now, is this a temporary shift, or is that company moving to that model long term because they've seen how their profits have changed? They've seen how their balance sheet has improved because the new office, quote unquote, is developing. Large companies had an easier path forward with pivoting. And they've had the easier path forward with pivoting because they've had the capital to throw at it. They've also had the infrastructure to implement more telework scenarios. Their employees already had computers, and they could take them home, and they were already doing temporary, part of the week work from home schedules, and they just kind of moved into it. Especially, like Microsoft or an Apple, they have certain infrastructure already built out for that. Now, these smaller companies, not so much, but yet many of them are still around. Whether it's a one-person shop, whether it's a 50-person shop, there are many of these smaller companies and startups that are even thriving in this environment because they found an easy way, a fast and efficient way to pivot into socially distanced, teleworking, eliminating that human interaction component of dealing with their clients. And there is where kind of your first opportunity will lie, in these companies that have not had the opportunity or had an easy go of this pivot during this time. Chances are the infrastructure can be built out rather easy. When it comes to smaller companies, when it comes to startups, capital is their Achilles heel for the most part. They were pumping money back into their business to get it off the ground or get it started. However, they needed to pivot, and so they're having to make adjustments more quickly. So they're building out their different infrastructure, and they're seeing their capital dry up rather quickly. And so, moving on to diving deeper into that first opportunity, capital is in need now more than ever, especially in the small business space. Now, I think it's a good time to kind of point out, you don't need to be an angel investor or a seed funder or a venture capitalist to invest in business and startups. There are more components if you're going to be doing it, yourself. However, we'll touch on that in a minute. But you don't need to be a venture capitalist to find these opportunities. Money is needed in a variety of different areas. Bootstrapping, and again, if you're not familiar with the term bootstrapping, that means that you have the one owner, he's the founder, CEO, marketing director, client relations, HR, he or she is doing everything for their company, and they're also working a second job to pay. So they're effectively, their company is living paycheck to paycheck or sale to sale. Bootstrapping is even worse than it ever has been, just given the people losing their jobs. They potentially have lost their job that was floating their bills as they built their companies. And the startups that were just getting off the ground were set back even harder because of that. So the need for capital is out there for these companies, and it doesn't matter if it's a restaurant, it doesn't matter if it's a technology company, it doesn't matter if it is a fencing company, a lawn service company, a chic designer backyard landscaper. Small business doesn't have to be the next generation of technology. It could be the next line of juice. It could be the next line of ketchup and mustard. The world is our oyster. We live in a very interesting country where opportunities and strategies are very, very abundant. And so getting into there's even more opportunities during this crisis because these situations, these times, any recession, if you look back throughout the annals of history, every recession has led to some form of innovation or some form of prosperity on the back end. And that's well outside of the stock market. That's about the tried and true will of the people. Whether it's people are now taking the chance because, well, I lost my job anyway. I'm getting tired of every time this happens, every 10 years or every 5 or 7 years, I'm getting laid off from my job. I'm taking control and I'm going to be taking this chance because why not? That person is going to be in need of financial guidance or assistance, or even maybe a guiding hand if you are a savvy business person. Think about if there are CPAs on this call. I mean, you are an expert in finance. Why can't you lend your time as well as your capital to be on the board of directors for a startup company and to be even more involved with the direction of where it's going? With the lowered cost of people in space, a little bit of money can go even further. People are finding that I don't need to pay for office space. I can pay part-time people to work from home now. So the cost of me doing my job and the cost of me running my business, well, heck, $25,000 can go a really long way. These Google ads or these Instagram advertisements out there can really push my product and get in front of my target audience much more efficiently than me going to several different networking events every week and trying to get involved with all these different associations that I feel that I need to get into. And so even more so than having the availability of these startups and of these businesses to invest in, the amount of money needed to get them rolling is significantly lowered given the current economic state. Now, you're probably thinking to yourself, Anthony, this is all well and good, but where do I find these companies? Look, you can't just tell me that there's opportunity. Where do I actually find the opportunities? And that is a very great question. Before we do get into that, let's take a look back. The two most recent recessions that we have experienced in 2008 and in 2013. And so who grew out of here? Really looking at it, there were winners during those times. It was not all losers. Well, the two biggest winners were commodities and cash. Commodities and cash. So commodities, items that people couldn't live without, or so they thought. The world, the financial mortgage meltdown and the financial crisis, the world is crumbling around them, but I still need my new iPhone. I still need my Netflix because I'm not, lost my job. So I got to sit around and watch Netflix for a while. Companies like Google, companies like Apple, companies like Microsoft. It was because they are savvy businesses, and we'll get into that in a little bit more depth, but that product line has positioned themselves to be a necessary commodity for the average American. So you look at the business model of those commodity types, they really position themselves to be the market leader. And they grew from that, even though people were losing money, people were losing jobs, and there was a crisis going on. Those companies grew. Now, they did more than just sell their products, and we'll get into that in a minute. As far as cash goes, companies like E-Trade and other diversified lenders, so Wells Fargo is a great example. You think about the 2008 crisis, banks were on fire. They're burning, not in a good way, not in the slang term of on fire, but literally burning to the ground because of what was going on. Well, Wells Fargo, with being savvy in positioning their capital more efficiently internally, they were able to weather the storm. Not saying that they didn't lose some, but came out of those crises so much better positioned and successful because of their diversified lending process. E-Trade positioned themselves that, hey, now's a great time to get into the market, be a day trader. Because of all the volatility, you can make a lot of money quickly. Again, that's a commodity / cash positioning there. But something like Wells Fargo, I think this is really important to know. Wells Fargo and Bank of America, those companies individually own over $21 billion in life insurance on their C-suite executives. Why the heck would a bank own life insurance? Well, it's because savvy companies have savvy assets. You think of the business model. Wells Fargo is a bank. Netflix is a streaming service. Apple is a technology company. That is their income generator, their cash flow generator. But what is Amazon doing right now? Right now, current day, Amazon, yes, selling a bunch of products online, but they are scooping up real estate assets like crazy. It's because they see the writing on the walls and they see the value of having negatively correlated assets inside the company's balance sheet. They see non-correlated assets that they can use and leverage to grow during times of financial crisis, because the stock market is reflective of the market in general. And yes, that affects the value of your said stock or mutual fund or ETF portfolio, but it doesn't necessarily dictate the value of the business itself. So it's very important to understand, if you're going to get involved in business investing and startup investing, even if you're using your IRA, you're not just an investor, you become a business person. And a business that has diversified assets on their company's balance sheet is more likely to weather some kind of financial crisis or some kind of global pandemic. Companies that buy real estate for growth, people that companies that bought other companies during certain times. Think about that. There are companies out there that are getting scooped up by other companies because they can. And so when you're going into that, you as the investor are going to have opportunities to create a diversified asset backing for those small businesses. And again, we'll touch on that in just a little bit of depth here in a minute. With opportunities comes challenge. Let's get back to where this slide is really directed. With opportunities comes their challenges, and finding a good fit for you or finding a company that you want to invest in is the biggest challenge here. With that, there are so many entrepreneurial network groups that are meeting virtually right now. And these groups, these meetups, these meetings are open to the public. It can be in Louisville, it can be in Tampa, it can be in Silicon Valley, it can be in South Bend, Indiana, it can be in Portland, Oregon. It doesn't matter. All of these networking events are open and lively to the public. LinkedIn has never been more active than it is right now. People out there getting their word out, being social in a professional manner. It just takes time to find a good fit for you. It takes time to find the groups that are worth spending some time in making those connections. I can speak to the greater Tampa Bay area, because that's where I'm located. Some certain venture capital groups like Florida Funders, Seed Funders, Florida Founders, which is kind of a subsidiary of Florida Funders. These groups kind of pick and choose the different companies that are viable through their standards, and they make those offerings available to investors that are either have cash on hand or using a self-directed. So that is one entrance point there. But again, being an accredited investor requires certain criteria. But groups like Synapse is a statewide organization that links the tech community all throughout Florida. They are hosting all sorts of events that are trying to link businesses with investors, investors with businesses, and businesses with other resources. And so, Google is your friend here. Eventbrite and meetup.com is your friend here. There are so many different local entrepreneurial meetups that are happening right now. And if you are a type that loves to invest in technology, these software companies are going virtual live very fast because they understand the product. They understand the process. Now, I think another good option that many people overlook are colleges. More and more colleges are creating that degree in entrepreneurship. And so you have a 22-year-old kid or a few 22-year-old people that are graduating from college that have the education, that have mentors already, that have business models built out. If they're graduating with an MBA in entrepreneurship, degree in entrepreneurship, they have to create a business model. Could be and should be put in place upon graduation. And so they have been guided to the point of getting their business rolling, capital being really their biggest Achilles heel when it comes to this. And so with that in mind, where do you look and kind of what do you look for? Do you go with a bigger company that maybe has a higher entry point? Well, you're going to get better experience. You're going to get better, more comprehensive balance sheets. You'll probably get a safer return. but you will also probably get a lower, smaller return. Whereas if you're getting a newbie fresh out of college, your return could be quite much higher, maybe a 10x, maybe a 12x of your initial investment, depending on how the payout is structured. It does not take long to find a business if you're plugging yourself into the network. If this is something you're looking to get into, you go to real estate investing meetups to meet other real estate investors. If you're going to do the hard money route, if you're going to try to meet syndicators, you're going to be around syndicators. Well, if you want to be involved with investing in startups, you need to be involved in that community. There are mentors of these entrepreneurs that are looking to pair them with the right kinds of investors as well. And so getting in with the mentorship group and positioning yourself as an investor, you will always be welcome in these groups. So where to look is put yourself out there, and talk with people, meet with people, understand their pitch deck and their business process and their model. Moving on to some of that next things here, and I'm not, I could go so far into this because I think this is so even more important than what has changed. But what hasn't changed during all of this crisis? I know it's a crowd favorite here at Advanta IRA, and that's real estate. For good reason. Real estate is alive and well. People are buying houses. I mean, Pinellas County, the inventory is so low, it's still a seller's market, even with everything going on. It's wild. But this vehicle as an asset hasn't changed. Now, how it is shifting a little bit, I would say, is there are some opportunities that I've seen that are moving away from just a rent roll, but they're moving into a social impact kind of view. When you're talking about real estate, especially from a business standpoint, you want to find a group that is running their real estate like a business. It's not just a flipper or it's not just a syndicator, but they have a business built out. They have a CEO, they have a COO, they maybe have a marketing director or an investor relations point of contact. And they're looking to not just bring in hard money, or they're not just looking for passive investors, but they're looking to bring in partners. You as the investor are a partner in the deal. And going back to that social impact component of it, I can speak to the St. Petersburg and the Tampa area. Here in South St. Pete, it's a lower socioeconomic area of town for the most part. There's an organization that's doing the St. Pete Flip Fund. The whole purpose is to gentrify an area of the city. You help those in need with your capital. You also get the capital. So it's a dual purpose here. And in the time of COVID-19, where we are in this together, having that extra additive of I'm not just making money with my money, but I am making a positive difference in my neighborhood, making a positive difference in my local community. That's not necessarily something that may be attractive to somebody in New York or Wisconsin, but there are different social impact investment options that are available out there, and especially in the real estate market, where it's something that has remained strong throughout history. Yes, there's been times where it has been cyclical, of course. But as for the business component of that, when you're looking at a real estate investor, dig a little bit deeper than, hey, this is the project, but tell me about your business. Who do you have on your team that's making sure that you're making the right decisions? Who do you have on your team that's vetting these deals? Who do you have on your team that's running your business income? How do I know where's my money being protected? And I think that's a very overlooked asset or aspect when you're talking about investing in real estate. Secondly, people haven't changed. As hard as they try, people don't change. We're not going to go without our creature comforts for long. And what I mean by that is you look back to 2008 and 2013 with commodities, food, beverage, alcohol, vitamins, home improvement. People are spending more time at home. People are making home improvements. So the growth in contracting and landscaping and fencing and interior design, those industries are, frankly, they're booming right now because people are just tired of looking at their house and that project that they can never get to. Things that make people's lives easier, software as a technology, different kind of webcams or setups and in-home studios. All of these are very important, but the actual point is, how are those services being delivered? Is there somebody that is innovatively delivering food or making it faster, cheaper, easier to get alcohol to their door. When it comes to health products, it's not just, oh, the science behind our liposomal technology. That's all jargon. How are you making it as painless as possible to get your products in front of your consumers? Or how are you planning to do it long term? Can you make this shift that you've pivoted into a permanent thing? From as far as the consumers go, we haven't changed. We will always change. But as far as the businesses you're looking into, are they shifting into an e-commerce platform? Did they or have they shifted into an e-commerce platform? Are they making it easier and or cheaper than the big box stores to get their products delivered to the end users? Or do you have somebody that's working with an Amazon to make the deliveries even easier, or working with FedEx and they're buying trade routes because they have, they just need capital to buy the trucks, but they've got all the trade routes for FedEx and they're making it easier for the big box stores that are footing the bill for their profits. Are they making it easier for those big box stores to reach their end users? And when things open back up, because we don't know when they will, crucial part is when things open back up, is their model going to shift again, or are they going to lean in even heavier to capitalize on opportunities? So people aren't going to change, but the delivery should change to make it easier for people to get what they want. Again, food, beverages, alcohol, technology, creature comforts, improvements to their home. Cost, money, baby, show me the money. Cost always matters to people. So for that, is the company that you're looking into, is the opportunity that you're looking to invest in, is it doing one of two things? They're certainly doing one of two things if they're going to be successful. First, are they making their product or service more cost efficient? So the buyers who are now in a financially tough spot, let's be honest, it's not great for a lot of people right now. Are they making their product and service more cost effective or cost efficient for their end users? And you can ask that question. What are you doing to accommodate for your end users that are buying your product? 75% of your demographic has lost their job. How are you making it easier for them? Whether we're in a pandemic or not, that's a great question to ask somebody. Or two, they're staying on brand. They're staying at their price point because they are a luxury item, and that luxury item and their buyers are insulated from this crisis. Think of certain technologies. So financial industries, a great example, someone in my line of work, CRM, like Salesforce or HubSpot. The financial services were deemed a necessary, essential service. And so those CRM contracts did not show any downfall. Medical and med tech, PPE and DME, that they were fairly well insulated and showed a lot of good profit during this time because of the need for respiratory equipment and personal protective equipment that's available to the medical professionals. So for cost's sake, one, are they doing something to make it more cost efficient for their end users? Are they extending their lowered cost of office space and personnel? Are they extending that savings onto their end user to make it easier for them to continue to have loyal customers? Or two, is their luxury item insulated from the crisis? Are there buyers of that luxury item or designer item, if you will, insulated from that crisis? Again, things to point out, things that haven't changed, concepts that haven't changed, but questions to ask during this time. If people don't know you exist, I don't care if you've got the best product out there, you're not going to sell anything. That's just the truth of the matter. Marketing will never change. Now, again, going back to a common motif throughout this whole thing, it's how is the marketing delivered? Where are people spending majority of their time? If you're spending $2,000, $5,000 on billboards, probably not the best place to be in marketing right now. Shifting to social media platforms, shifting to Google ads or other strategies like that. Are they staying on brand? Is the company staying on brand? Is the company leading with the sale, or are they leading with the value? You think about a company like, an example like Toyota. Toyota, we're all in this together, so come buy a Toyota vehicle. Like, they're leading with the sale there. There's no value add there. We see someone like, I believe it was Coca-Cola, that the whole commercial was about people helping people and doing the right thing and keeping their social distance and giving back to their community and those in need. They never once showed anyone buying a Coca-Cola. Yes, the Coke brand was there. Maybe they were wearing Coca-Cola swag and gear, but they were leading with the value. And so for these smaller businesses and these startups, are they just pushing product because they can afford it now? Or are they just pushing advertisements to the point of sale? Or are they solving an actual problem? And their brand and their marketing strategies are built around the value that their product or service brings and not just the sale. And as you'll see, that's very important moving into the kind of the end game when it comes to investing in these companies. And lastly, communication. Folks, I cannot harp on this enough. This is so overlooked by the founders and the CEOs of these smaller businesses or these startups. But now more than ever, can they speak well over the phone? Do they come coherently? Are they in a quiet space? Are they doing the things correctly when no one's watching? Because at home alone, it's really easy to do the wrong thing. But are they doing the right thing? And can they speak well over the phone or over Zoom? Can they write an excellent email? Their written communication needs to be fully on point. When they are texting you as the investor or other employees of their company, are they using full words or are they not? And again, for right or for wrong, are they doing a professional job with their written communication? When you can't see somebody else, when you can't see the other person, if they're not sitting across the table or the desk from you, you have to be able to deliver the strongest of messages over new and alternative mediums now. And I could have probably put the communication piece in its own category. But investors, you should be weary when the CEO or the founder or the top level employees of this company cannot and will not communicate well with you. It is a big red flag. But if they come off as very professional, the emails are sharp, very coherent, very clear, they're not rambling, full words, no errors. This is such a crucial component. Communication is a necessary item. But when you're vetting deals, when you're looking at companies, when you're looking at opportunities, that communication piece is big because when it's not done well when they're trying to ask you for money, it's certainly not going to be done well once they have your money. To round it out, what should you as the investor be looking for? The short answer is I have no idea. I don't know you. Okay, that is the truth of the matter. I can't tell you what you should be looking for. I have used a lot of different examples. I've used a lot of different examples as far as technology companies, SaaS companies, video webinar companies, lawn care, fencing. I mean, think about blue collar jobs. They're social distanced right there. They don't need a big team to do residential improvements, and they can stay far away from their customer. And so, expand your viewpoint of what a quote unquote business is. As long as the business has a model, as long as the business is generating cash flow, if they need capital, they need money to finance new equipment, bring on temporary employees, expand their market share through a marketing strategy, or to bring on a marketing director. All of those are good reasons for wanting and raising capital. Some of these people don't even consider asking investors. And so putting yourself out there. I don't know what you should be looking for, but you do. These opportunities are not going to be prosperous if you're looking for profits alone. There is a reason that the business that you're looking at got started in the first place. There was a dream, there was a vision behind it. Now, if there is no vision behind the business that you're looking at, you need to look elsewhere immediately. If there is no why behind the money being made, you need to leave that opportunity alone. You have to find opportunities that mix well with who you are. If you are a tried and true real estate investor till you die, you may not necessarily need to be looking at tech companies. You may not necessarily need to be looking at DME and medical device or pharmacological startups. You don't need to be looking at those kind of things because they go against your grain. You don't understand those products. You don't understand that industry very well. And so you're just throwing money at the situation thinking you're going to get profits. Again, if you are looking for profits alone, the chances are you're going to expose yourself to way more risk than you need to. But my recommendations kind of as a whole for people looking to get into business investing and startup investing, and this is standard advice that I would give to uh, all of my clients and everyone that I work with, is first you need to get organized. You have no idea how much money you can put towards a business if you have no idea how much money that you have and where all your money is and how it fits into your overall financial plans and goals. Okay, get yourself organized is square one. All right, I'm not going to say any more on that. Get yourself organized and know what you're doing. Uh, no more than 15 to 20% of your net worth. If you're a little bit older and you have surplus capital, you can flirt with the 20%. But my kind of base advice is, if you have to allocate $100,000, but your net worth is $500,000, you should not, and I'm not telling you you can't, but it would be my recommendation that you should not allocate 1/5 of all of your wealth to a single opportunity. And so really no more than 15% of your net worth should be based into these opportunities. And again, that starts, and you should know that number because you got organized first. All right, that's the last time I'll mention that, I promise. Now, number 3, people haven't changed. I mentioned that earlier. Okay, so find who you know, like, and trust. I know that there is the arm length rule with self-directed IRAs, and that does kind of limit maybe the people you know, like, and trust the most. But the people behind the income, the people behind the money, the vision during the time of crisis, and the why, okay, is going to lead to the more success than the actual product being sold. If there is a true why behind that business, if the people behind it are visionary and capable, and they've surrounded themselves with how. If they are all why and know how, there's issues. But if they have a clear vision of what they want, and they've brought on people, maybe it's even you as an investor that are the how people as far as the mechanics of the business may be running, that's going to lead to some great success. And match your why. If hey, we want to gentrify low income neighborhoods. Well, I don't really care about low income neighborhoods, and it's not that you're a bad person. You just care more about homeless veterans, or you care more about vets getting to dogs and cats. You have to match your why. You have passions and loves in life. Make sure that the company that you're behind, it matches your why, and the vision behind that company matches yours. And go with an industry that you know. If you're a real estate, look into co-working spaces, look into apartment buildings, look into potentially even hotels, or a business that is in the business of short-term rentals. Again, getting that business model behind the asset, not just the asset itself. And then kind of lastly here, if you are not going to go through a venture capital firm, or you're going to be out there investing in these companies by yourself, get a lawyer involved. And it's not to be cold or mean, it is to make sure that everything is clearly defined. Getting a lawyer involved makes sure both sides of the party knows the agreement and what is to be expected, as far as not just return, but the involvement of you as the investor. If you want to be on their board, if you want to have more of an active role, make sure there's legal documentation that states the parameters and your involvement in it. So don't be afraid of the lawyer in this situation. They're there to help and to make sure that not only your money is protected, but the business is protected as well. If you don't care about the business, you shouldn't be running your money into the business anyway. Another thing to very much look for, especially in the startup space, is when they're giving you a hockey stick chart for investing. Hey, you give us this money, 10 years from now, we can expect 50%, a 50x return on that initial investment, 10 years down the road, whatever it may be. Anybody can project. Literally anybody can make projections on what should happen. We have no idea what's going to happen. We don't know when the next recession is going to happen. We don't know if this person's going to have a divorce. We don't know if their personal life is going to interrupt the business operations. Do not look for projections in the business. Look for a solid, well thought out budget. How is the money being allocated? What are the profit? What's the cost per dollar of your capital? Where is the money being positioned to make more money? If you have income coming back into the business, is it just getting shoved back into marketing? Is it getting shoved back into R&D? Are you positioning it to be tax friendly? Are you acquiring other assets? Are you bringing on new employees? Where is the money that I'm going to give you? Where is it going? and how is it going to make your business money. So look for a budget. A budget is so much more valuable than a projection to an investor. And lastly, and I hope this goes without saying, when in doubt, don't. If there is a shadow of a doubt, you work very hard to save and to structure your financial life. If you have doubts about the opportunity sitting in front of you, there's going to be another one. There will always be another one. So don't have FOMO, don't go with the herd, do your due diligence, consult your professionals, and get it done the right way the first time so you don't have to suffer any losses. I'm not saying guaranteed performance on any of these, but I am saying that when in doubt, do not do it. And so the last slide there, if you will, advance me one slide. That's just thank you. That's my contact information. If you have any questions outside of the webinar, please feel free to reach out to me. That is my direct line. That is my email address. And if you want to know a little bit more about who and what Jared Bunch is and does for our clients, jaredbunch.com. Go ahead and check it out. And if you want to chat, there's my contact info. Larissa, stage is yours.
Yes, thank you so much, Anthony. That was amazing information, and I know we'll probably have some questions later on. I just put my email address in the chat box for everybody. If you're looking for me to give you a certificate showing you attended and completed this hour with us, please email me and I will make sure to get that for you. And again, I cannot tell you whether or not for sure it will cover your CPEs, but certainly I'll give you the certificate and you can check in with your reporting agency. I believe I have another slide with my contact information. Yes, good reminder. I also wanted to let you guys know that you can check out any and all of our events coming up by going to advantaira.com/events. You can also check out our video library. Go to YouTube, search Advanta IRA. Everything that we record and save will be there, as well as this webinar at some point later this week. We have a whole bunch of really great opportunities coming up. And I know Anthony mentioned networking, and that really is one of the most important pieces of the puzzle for making investments. And so I've been networking with clients and contacts and investors for years and years now with Advanta. As I mentioned at the beginning, I've been with Advanta almost 10 years. And so I would definitely say that if you're looking to find out more about investments, and to learn more about different strategies people use, make sure that you're networking. And I know right now it's very, very difficult, but there are still lots of opportunities. If you go to meetup.com and search networking for business startups, for example, you'll find that there are meetings being done with Zoom right now. They're all the time. I'm doing a lot of Zoom meetings myself. And so there's still opportunities to network. And of course, if and when we get back to normal, we're going to see more opportunities pop up for networking. So I definitely recommend checking out Meetup and looking for local opportunities. And you know what? You have to take the good with the bad. The opportunities for networking are going to be nationwide for everybody right now because you don't have to drive to the meeting. And so I'm on networking events that are in California and Colorado, and even just south of here, but 3 hours south of where I'm located. So ordinarily it would be difficult for me to attend. So, taking the good with the bad, there's opportunities out there to network nationwide right now because you can do it through Zoom. So again, here's my contact information. I just want to thank Anthony. Thank you so much, Anthony, for joining us and sharing that information. It was great information, and a lot of people are going to be looking for those opportunities, whether it's in business startups, real estate syndications, or even just investing in general post-COVID. And so it's always good to have information, more tools in your tool belt so that you can go forward with confidence. So I really appreciate you joining us today.
Oh, it's always a pleasure. It's always a pleasure. Thank you as well for having me.
All right, and with that, we're going to end the webinar. Thank you so much, everybody, for joining.